Hey, hey, hey. Hey, friends. How you doing? How you been? Happy Friday to you. Happy Friday, friends. Happy Friday. Leave a comment in the chat. Let me know how you're feeling. Let me know how you're feeling. Because it's been another whirlwind of a week. I have a feeling every time we meet, every Friday we meet this year, it's going to be after a new roller coaster ride. Because, honey, the stock market has been on one, right? The stock market has been on a roller coaster ride this week. Ooh, child. There's been a lot of chatter about stock market crashing, a whole lot of fear mongering, probably some panic selling. The tea is hot. It is hot. So, in this video, I wanted to take some time to share with my financial friends and my financial besties. I wanted to share what smart investors know and what we know keeps us calm even as the market drops. Because, sis, I don't care what Felony 47 does. I don't care what his minion Elonia does. I don't care how much the media talks about doom and gloom of the stock market, or even what your neighbor says about, oh, this time is different. You should sell everything. I want you to know that I, Malika, your financial bestie, is not worried about a stock market crash. Not even a little bit. Oh, so I want to talk about that this evening. And while I'm thinking about it, after I finish with this public live stream, I want to meet with my financial bestie channel members for a stock market crash Q&A. If you want to discuss your concerns about the market a little deeper, if you want to discuss any concerns about your portfolio that you don't want to share on the public live stream, join me in the private live stream for financial besties only. If you are not a financial bestie, if you are not a channel member and you would like to become a financial bestie, the link to join, I think the button that says join is right below this video somewhere. But join me in the private live stream and let's talk about your concerns. And if you're not a bestie, become a bestie so you can join the private live stream as well. What else I want to talk about before we get into it? If you're new to me, hey girl, hey. As I mentioned, my name is Malika. I am a stock market investor and I'm a money coach. Prior to becoming a money coach, I was a single mom on welfare for almost 10 years. But everything, my whole life changed when I discovered the power of investing in the stock market. Through years of learning how to navigate the stock market, the volatility, including the ups and the downs, and making some strategic investment decisions, I achieved financial freedom and retired early at 47 by investing in the stock market. I've been an investor now for over 20 years. So I've seen quite a bit of volatility and I've seen several crashes and dozens of corrections. But now I'm on a mission to help other women learn how to invest for their financial freedom too. So if that is of interest to you, go on and tap that subscribe button down there. Subscribe to my channel and turn on the notification bell so you'll be notified when I upload a new video or go live, which I tend to do on Friday nights at 7 p.m. Eastern. But don't hold me to it because I'm not always here. But I try to be consistent. And if you are a stock market investor, I have some links in the video description to help you. There is a free investor guide to help you avoid some very expensive investing mistakes. And there's some links to ways we can work together. If you need help with your portfolio, building your portfolio, making changes to your portfolio, whatever you need assistance with, or you just have questions for me, there's some links that we can work together that's also in the description box. So welcome, new friends. Welcome, welcome, welcome. Let me say hello to my OG besties. Then we will get into the topic for today. What smart investors know that keeps them calm, even while the stock market is dropping. But let me say hello. Let me say hello to my friends. Hello to my friends. And as always, Miss Tanya Brooks is first in the house. Hello, Miss Tanya. Miss Tanya, I'm sorry. I always pronounce your name wrong, even though I know how to say it right now. But hello, Miss Tanya. How are you? Oh, and I just realized that this might be some of your first times seeing me without my head wrap, seeing my head, what my brother call it, my milk dud. My brother is a hater, y'all. My brother is a hater. He called me milk dud head. But yeah, I am 6 weeks from finishing chemotherapy. So this has been my new look for the past couple of months. I've done a few videos with my new look because I like it, but my head stays so cold. So I cover it up most of the time, only because my head is cold. But it's starting to get a little warmer outside, so I have been managing without it, trying to get some color to my scalp. My hair is growing back a little bit. I don't know if you can see it, but it's growing back, and it's growing back so soft. Oh my goodness, it's so soft and so smooth feeling. I don't know if I'll let it keep growing because I actually like the bald look, and I would like to stay bald at least through the summer while the weather is warm. But it depends on what my hair looks like as it continues to grow. We'll see. But if I don't like it, I'll go back to the barbershop and shave it right off again because I like my look as long as it's warm outside. But anyway, Michelle, what's up, friend? How you doing? How you been from the DMV, my hometown? What's up, Tracy A? How you doing? How you been? What's up, Miss Tay? How you doing? How you been? Hello, Living Healthy Channel. So good to see you too. What's up, Miss Gail? I am so glad. I am so glad you are not worried. I will let you know when you should get worried. I'll let you know. But yeah, I'm so glad you're not worried. We have no reason to be worried, and I'm going to tell you why in this video. Hello, Miss Nick Strix. How you doing? How you been? Hello, Dr. Donna, Sister Circle member. How you doing? How you been? How you doing? How you been? Let's see. Did I say hello? Aw, thank you, Miss Crystal. Hello. Thank you. Hello, Miss Michelle. Thank you so much. Thank you so much. Y'all are so sweet. Thank you, thank you, thank you. Who's Anne Marie? Who's Anne Marie? If she's a Black woman and got a bald head, I know she's beautiful. I know she's beautiful. And if she's rocking it, I know she's confident too. I would love to get to know her. The fact that you even mentioned her sounds like somebody I need to know. But thank you all. If you come in later and I don't get a chance to circle back to you, hey girl, hey, to you too. But anyway, let's get into the topic. As I mentioned, I have been a stock market investor for over 20 years. And in those 20 years, I have seen dozens of market drops. I've seen drops as little as 10%. Those are like little flutters. I really don't pay attention to them. But I've seen drops as large as almost 60%. And despite that market volatility, because the stock market is going up and down all the time, But despite the market volatility and despite how large the drop may have been, I still invest with ease. And here's why. Here is why. Because in the past 20 years, so I've been investing for probably 22, 23 years, but let's just stick with 20 years. So since 2005, the past 20 years, the US stock market has seen at least 3 major market crashes. Hold on one second. Let me pull up my notes because I don't want to lead you wrong. I want to be able to share actual facts. I did some research and made some notes so I can share actual facts. A lot of it I do know from the top of my head, but I want to make sure I share factual information. But there have been 3 major crashes in the past 20 years where the S&P 500 has declined by 20% or more. Where the S&P 500 has declined by 20% or more. It has to be a drop of 20% or more for it to be considered a crash. Are we in a crash right now? Let me know in the comments if you think we're in a crash right now. That should be your first hint. Well, I'm not concerned. But even if we are in a crash, still not concerned. Let me know in the comments. Do you think we're in a crash right now? Do you believe we're crashing? Do you think we're in a crash right now? Let me know in the comments. But Run J Rhyme said no. Let's see what a few more of you think. Dr. Donna said no. Nick Strix says, I think we're heading towards a crash, but I feel like it's the best time to buy. So what's heading towards a crash, Nick Strix? What's a crash? In your opinion, what's a crash? I know Dr. Donna knows because she's in my coaching program. So don't answer her. Don't answer for her, Dr. Donna. But anyway, the US has experienced 3 major crashes in the past 20 years. And in this video, I'm going to tell you a little bit about each of the crashes. I'm going to tell you what caused them. I'm going to share how long it took to recover from them. I'm also going to share how investors responded. And in those 20 years, my lessons learned from each of the 3 major crashes. So for those who can't stay for the entire live stream, I'll share all 3 crashes with you first, and then we'll get into the details. But let me see if anyone else has responded. Do you think we're in a crash? And Nick Strix, I want to see your response too. You're saying we're heading towards a crash. What does that mean? So what is a crash to you? I'll give you a second to answer just in case you're typing. Give me a second to answer just in case you're typing. Michelle Lynn Thompson says no. Michelle Lynn Thompson says no. At the end of this video, I'll share my charts if I have time, because I need to meet with the Financial Bestie channel members. But I'll share my charts to show you exactly where we are in terms of the levels. But the 3 major crashes that the US stock market has seen in the past 20 years are Nick Strix says market instability and a drop in the US dollar value overall. That is not what indicates a stock market crash. We have market instability right now, right? The US dollar value has been dropping for several years, right? I am in a lot of Mexico expat Facebook groups. because I have residency in Mexico and I lived there 2 years ago. Last year, there was a whole lot of stress because the peso was gaining ground on the US dollar, and the exchange rate was not favorable for people that had US dollars because all the expenses was going up, all the bills were going up, the rent was going up. It was like, oh, you pay 15,000 pesos for rent, but when the exchange rate is not favorable for the US dollar, even though you're still paying 15,000 in pesos, the US dollar conversion goes up. But anyway, that's not the purpose of this video. We could talk about US dollar value and how it's impacted globally. We can talk about that in another video. But anyway, the three major crashes that we've experienced in the past 20 years. Number one, the 2008 financial crisis. And Nick Strix, I see your comment. You're fine. As I go through this video, the things I'll share, you'll be able to put the pieces of the puzzle together to determine what's an actual crash, right? But the three major crashes that we've experienced in the last 20 years. Number one, the 2008 financial crisis. This was the worst crash since the Great Depression. The S&P fell by 57%. 57%. I was investing during that time. The second major stock market crash was the 2020 COVID-19 crash. It was one of the fastest crashes in the US stock market history. The S&P 500 fell 34% in just a few weeks. Whew, I was investing then too. And the third major crash that we've experienced in the past 20 years is the 2022 bear market. The S&P fell 25% from its peak. I was investing then too. And here's the crazy part. That's also the year I decided to quit my job. I quit my job in May 2022 at the height of a recession and in the middle of a bear market. I should tell you how confident I am about investing and navigating the stock market. I had some concerns when people was talking in my ear and questioning my decision, the timing of it. But in hindsight, it was one of the best decisions I've ever made, and I have absolutely no regrets. And if I had to do it again, I would. But yeah, the 2022 bear market, S&P fell 25% from its peak. A few other notable drops in the market, but these are not official crashes. And this is for you, Nick Strix. You'll see why. Pay attention to the percentages. The 2011 U.S. credit downgrade in the European debt crisis, the S&P 500 had a drop of 19.4%. And another notable drop that's not really a crash was the 2018 market sell-off. The S&P 500 dropped a little over 19% in the fourth quarter due to trade war fears, which is very similar to what we're experiencing and what's causing the sell-off right now. The market dropped a little over 19% in one quarter. Right? And this is just in the past 20 years. The stock market has been around for, I believe, like 100 years. This is just in the past 20 years since I've been investing. We've experienced three major market crashes. So now I've shared the three crashes. Let's get into the details of these market crashes. Let's get into the details. I want to share with you, as I mentioned, what caused them, how long it took to recover, how investors responded, and my lessons learned. So you can understand why I'm not worried about the Cheeto or his minions. Let's get into the details. First up, the 2008 financial crisis, the Great Recession. This is referred to as the long and painful crash and the long and painful recovery. And the reason why is because the market dropped 57%, and it took 17 months for it to get to the bottom before it bottomed out. So imagine 17 months of a slow leak that's slowly creeping down. I'm sure many of you in this live stream remember that, because it wasn't too long ago, 2008, 17 months of a market drop. That's almost a year and a half of negativity. Can you imagine the chaos, the panic? I have so many clients that come to me that say, I sold in 2008. This market crash was due to the subprime mortgage crisis. A lot of lenders were getting greedy. A lot of lenders were taking shortcuts and approving people that should not have been approved. A lot of people were giving borrowers those subprime mortgages, the adjustable rate mortgages, and the rate adjust in 1 or 3 years by 2% or 3%, and the people can't afford their mortgage. It's like everybody was buying a house, and the lenders were giving everybody a loan. At some point, it had to stop. At some point, it had to stop. Banks collapsed, and we entered a recession. It took the stock market 4 years and 5 months to recover. So it started at the peak in October 2007. It bottomed out all the way through March 2009, and we didn't get back to the pre-crash high. Not going beyond it, just getting back to where we started. We didn't get back there until March 2013. The market rebounded as the Federal Reserve cut interest rates and launched a stimulus program. All right, y'all remember that? Nick Strick says she remember family on the news. Yep, everything is higher now than then. Yeah. Y'all picking up what I'm putting down already, and I'm just getting started. Yes, you get it. But I want to share how investors reacted during the 2008 financial crisis. So there's always two sides of the coin, right? I'm going to share how investors that made it out unscathed reacted, and I'll share how investors that were financially harmed or at a financial disadvantage reacted. So the investors that were long-term investors, more buy and hold investors, they stayed invested. It was hard. I ain't gonna lie. It was hard seeing my portfolio cut in half. But long-term investors continued investing even through a 57% drop. What helped is those of us continued investing, and we bought new shares at the bargain basement prices. Imagine buying your favorite pair of shoes, your favorite pair of jeans, your favorite designer handbag that you can't afford right now, but it goes on sale 57% off. Are you buying? Are you buying it? Because, honey, that's what I was doing in 2009, 2010, 11, 12, and 13, okay? And investors who reinvested their dividends and stayed patient, we saw massive gains during the bull market through the rest of that decade. From when did when did we get back to the pre-crash highs? What did I say? We got back to the pre-crash highs in March 2013. So for the rest of that decade, through the end of 2019 was a bull market. And those of us that stayed investing, that was buying at the bottom, that was buying for 57% off, right? And that was reinvesting our dividends, so getting more shares for free. We were still in the market when the market started rebounding, and for the rest of the decade. So, what's that, 6.5 years? We were in an aggressive bull market. So, the market recovered, y'all. The market recovered, and those who stayed invested came out on top. But those who were worried, those who were concerned, the panic sellers, those who went to cash and said, oh, I need to hold on to my cash. The stock market is scary. Most of them sold at the bottom. Not only did they sell at the bottom, because it was a slow drop, because it dropped so slowly, they were afraid to get back in, so they missed the recovery. Some of them never reinvested, which permanently locked in the losses. If you bought at 100 and the stock market dropped 57%, so that means you sold at 43, you locked in your loss permanently. And then when the stock market goes back up to 150, because you're afraid and you're sitting on the sidelines, you miss out on all the recovery. And then when the market recovers and start booming again, and then the stock market gets back to all-time highs, let's say 175, that's when you choose to get back in. That's when you're going to get back in. Because that's when most people that are afraid, that are talking about the doom and gloom right now, that's telling you to sell everything, that's usually when they get back in. They've locked in a loss of 57, and then they don't get back in until the market has doubled and it's at all-time highs. That's when I'm selling. And I'm selling to you because you're willing to buy at all-time highs. And that's how you make me rich. That's how I built my portfolio to retire early. Are y'all picking up what I'm putting down? The lessons I learned from the 2008 market crash is the market always recovers. So patience is key. Those who keep investing make huge gains when the bull market returns. And selling out of fear, you will lock in your losses permanently. All right. That's just from the first crash. Let's see. Oh, thank you, Angie Mo. Thank you so much. I'm glad you're here. Channel member. Are you a Financial Bestie channel member? I'll do a live stream after this, private live stream with the channel members after this. So Trading Places taught you to buy low and sell high. You know, that's a very popular saying. It's trendy to say, but it's counterintuitive, because you work so hard for your money and you put it in the stock market. And when you see your money dwindling down to half of what you put in, it's human nature to be afraid, to want to pull it out, because you work so hard for it. You want to preserve what's left because you associate money with hard work, with the hours, the weeks, the months, the years you put in to all of your life savings, your 401k. That's what all the fear mongers are talking about. Your 401k. Save your 401k. So while that's saying buy low, sell high, it's true. That's what you do, but it's not intuitive. So some people say it, but don't actually do it. Most people say it, but don't actually do it. And most people think with every market crash, this time is different. This time is different. So I got to pull all of my money out. I don't know what Trump is going to do. He's making enemies all around the world. He's going to crash the stock market. I got to save my 401k. That's what you're hearing these days. Right? That's what you're hearing most of the time these days. So let's talk about the second one. The COVID-19 crash. As I mentioned, this was the fastest crash and recovery in history. The market dropped 34%. It peaked in February 2020. Right? So following the rebound of the 2008 crash, that the bull run continued through the end of 2019, right? So this crash was right on the cusp of that bull run. So the bull run peaked in 2020. Run, J, run. You can become a bestie by clicking the join link. There's a join button right at the bottom of this video. All right, look right at the bottom of this video, you'll see a join button and it'll show you 2 membership levels. Click on the Financial Bestie membership level and you can get access to all of the live streams, all of the members only videos, and all of the members only shorts that I post. Okay, and if anyone is a member of the channel but not at the Financial Bestie level, you can upgrade your membership so you can access all of those perks. But the COVID-19 crash, it started at the peak. The stock market peaked in February 2020, and then in just 1 month, it bottomed out in March 2020 and dropped 34%. So when people say, well, how fast can the market drop? Or when is the bottom? They're trying to time the bottom. They're like, oh, well, I'm going to wait another month or 2 or another couple of weeks, and then I'll start buying again. This right here was evidence for me that you cannot time the bottom because this crash happened so fast. And the recovery was in 5 months. We were back to pre-crash highs by August 2020. So in just 5 months, it smacked the bottom fast and it rebounded just as fast. So you can't time the market. There is no one that can tell you how long a crash is going to last or tell you how long it's going to take for the crash to rebound. So if you're waiting on a perfect moment to sell or to buy, or you feel like now is the time to get out, you don't know when the market is going to start rebounding again. So you're going to lock in your losses and then miss the rebound. But the cause of the COVID-19 crash in 2020, of course, was the global pandemic, right? The worldwide shutdown. So businesses weren't operating, right? A lot of uncertainty because no one knew about this thing called COVID-19. It was killing people around the world. It was blind to nationality, to race, to gender. It was hitting everybody. So there was a lot of fear and uncertainty, and that led to a lot of panic selling. The stock market does not like uncertainty. But the recovery was fast. 5 months, just 5 months. The market rebound primarily due to the Federal Reserve intervention. Again, the Federal Reserve cut interest rates and they issued stimulus. And that pumped energy back into the economy, right? Getting money flowing again, right? As long as interest rates are low, that means it's cheaper to borrow. And then when you're giving out stimulus, sending everybody a $400 check, most people are going to spend it. A lot of people started investing in the stock market. So they put that $400 in the stock market. But a few ways that investors responded to the COVID-19 crash. Again, I'll share with you both sides of the coin. Smart investors bought aggressively during the dip because a lot of us remembered the 2008 crash and regretted not buying more. So when the opportunity came around again, We was like, oh, yes, yes. So smart investors bought aggressively during the dip, knowing that the market would recover. Another thing is tech stocks. Tech stocks went through the roof. Tech stocks led the market recovery pretty much. So investors that bought into Apple, Amazon, Tesla, Google, anybody that know me, and if you in any of my coaching programs, you know Apple and Apple and Amazon on my base. Google is on my list right now too. But I got a whole lot of Apple and Amazon back during the COVID-19 crash. And I think Microsoft was a big runner then too. But the Fed stimulus and the low interest rates, it pushed the stocks to a record high by the end of 2020, right? But on the other side of the coin, panic sellers, they missed out because a lot of people sold in March 2020 because the stock market dropped so fast. So they were afraid and they just knew this one is different. They missed out because the market rebounded just as fast. It was the fastest rebound in US stock market history. And the panic sellers that was sitting on the sidelines after locking in their losses, then they missed out on the rebound. So when you panic sell, you're losing twice. When you panic sell, you're losing twice. Number one, you're locking in your losses. And number two, you're going to miss out on a rebound because you're going to be too afraid to get back in. So many people expected a longer recession because the last one was longer. The last one lasted, what did I say, 15? The last one, the crash, it took 17 months to get to the bottom. And then it took 4.5 years to recover. So a lot of people expected a longer recession, but the Fed stepped in and their aggressive policies pushed the market back up quickly. And the people that were sitting on the sidelines and that sold, they missed out. They missed out. So that was the second time panic sellers missed out. My lessons learned. Number one, time in the market beats timing the market. We didn't know how fast the market was going to crash, and we didn't know how fast it was going to rebound. As long as you stay in the market, you ain't got to worry about that. Another lesson learned from COVID-19 is crashes can recover quickly. Crashes can recover quickly. Nobody knows which one is going to be fast and which one is going to take a long time, but we do know now that they can recover quickly, and panic selling lock in losses. And my third lesson learned, after seeing it that second time, government intervention can fuel fast recoveries with the stimulus and the rate cuts. Government intervention can fuel fast recoveries. The third crash I want to talk about is the 2022 bear market. 2022 bear market. The market dropped 25%. The market dropped 25%. It peaked in January 2022. So from the COVID-19 rebound in August 2020, we were on a bull run from August 2020 to January 2022. And then we entered a bear market. There was too much money circulating in the economy. It was too much. The government overcorrected. So it peaked in 2022, January, and it dropped 25% between January 2022 and October 2022. So it took 9 months to bottom out. You see, there's a range. No one knows exactly how long it's going to take to bottom out. The first one was 17 months. The second one was 1 month. This one, it only took 9 months. So if you panic sell and you think you're going to sit on the sidelines and wait for the bottom, you don't know when that bottom is going to be. You don't know. The 2022 bear market, it took 14 months to recover. And what I mean when I say recover, I mean getting back to where we were before the crash. So the recovery started in about 9 months. but it took 14 months to completely recover to get back to the pre-crash high. And we recovered in November 2023, right? This crash was caused by high inflation, way too much money circulating in the economy. Dropping interest rates and giving out them stimulus checks, it was overcorrection. When people have too much money available, they spend a lot. And I guess that's just the nature of our capitalist economy. But when people are spending a lot and they're buying a lot, it causes prices to go up. When demand is high and supply is low, sellers raise the prices. So inflation went through the roof. Inflation went through the roof, right? It was too high. In addition to that, the Federal Reserve stepped in again and they raised interest rates. That's what also caused the crash. The Federal Reserve overcorrected. They dropped interest rates and then they raised them really fast, really high. And another thing that triggered this crash was the Russian-Ukraine war. Russia invaded Ukraine. So the geopolitical uncertainty, which is very similar to what we're experiencing right now, right? We have so far what I've mentioned that caused prior drops. We got the trade wars, right? And then we also have the Russian-Ukraine conflict that's still brewing and getting more concerning. So we have like a melting pot of several things going on at the same time that in the past caused different crashes, but now they're all going on at the same time. And that is what's causing our current market volatility, right? But the recovery for the 2022 bear market, inflation slowed down, right? And Federal Reserve raised interest rates. It slowed down inflation. So when borrowing money is too expensive, people stop spending. So inflation slowed down. It lowered the inflation, right? And then the economy started improving. And because of that, investor confidence returned. And then people started investing again, right? But here's both sides of the coin and my lessons learned from that one as well. Run, J. Run, welcome, welcome. Nitrick said, you just made me realize how many small businesses started during COVID-19 and all the small business loans too. Yep, those PPP loans? And some people were getting the PPP grants and didn't have to pay them back. So much money was being flooded into the economy. Too much money is not good either. You need a perfect balance in order to balance the economy. A whole lot of money and low interest rates, that's a recipe for problems. Cause the market to crash. But those two sides of the coin. Hello, Miss Deborah, channel member. How you doing? How you been? I think I saw another channel member up here. I said hello to Miss Angie Mo. I always need to speak to my channel members. Hello, Miss Diane, channel member. How you doing? How you been? I'm doing a members only private live stream after this to answer your questions about the stock market or your questions about your personal portfolio. So if you are not a financial bestie channel member, you can upgrade your membership and participate in the private live stream. But both sides of the coin, right? In response to this 2022 bear market, you have investors who stayed invested. Hey, girl, hey. And we continued the dollar cost averaging, right? We continue dollar cost averaging. Those that invest in index funds and ETFs, you don't have to be doing anything complex or anything advanced to benefit from market crashes. All you need to do is continue to invest, right? And then those investors that continued investing, they saw those strong gains when the market recovered. And again, tech stocks. Whew. I try not to go too heavy on tech. It concerns me when I see a lot of you going heavy on tech. If you're in my coaching program, I'll call you on it. But if you're not in my coaching program, it ain't none of my business. But I see you, and it concerns me a little bit because when you're too heavy on tech, that 57% drop will look more like 87% in your portfolio. But tech also rebounds strong too. So if you don't have the risk tolerance, if you don't have the stomach for those big drops, your portfolio should not be heavy in tech. But after this 2022 bear market, tech stocks, specifically AI, surged in 2023. And it was a beautiful, beautiful reward for those who held out, that continued investing, and that continued investing in companies like NVIDIA, of course, Microsoft, and my new buddy, Google, right? But the flip side of that coin, those who tried to time the market missed out on gains. A lot of investors feared the rate hikes and they thought it would be problematic. So they stayed in cash and they missed out on the rebound. They missed out on the recovery. Some investors switched from equities to bonds and CDs, and they missed out on the 2023 stock market boom. They missed out on the boom while they kept their money in safe investments because they thought it would continue dropping. So my lessons learned from the 2022 bear market. My lessons learned were, number one, the market can recover at any time, even if things are still uncertain. Because I know a lot of you are probably thinking, oh, well, the Federal Reserve stepped in before. Now the Cheeto controls the Federal Reserve, or the Cheeto can influence this and influence that. The market can still recover during uncertain times. The 2022 bear market showed me that, right? My other lesson learned is that when you are trying to time the market, you're going to miss, because there is no one, even the experts, that cannot get it exactly right. You are going to miss. You're going to lock in your losses. You're going to sell at the low. You're going to miss the gains during the recovery. You're going to miss the gains during the recovery. And you're most definitely going to miss out on tech rallies, because tech drops hard, but then it also rebounds and rally just as hard. And most people, when they lock in their losses because they're so emotional about the money they lost, they tend to sit on the sidelines and be afraid to get back in. It's like, you remember we were younger and we were playing double dutch and we were trying to figure out what was a good time to jump into the rope. That ain't how you navigate the stock market. That ain't how the stock market works. There is no perfect time to get in, right? And even when the market is down, there is no perfect time to sell. And if there were, by the time you realize the market was dropping, it's already too late. If you sell, you're going to lock in losses. So my third lesson learned was diversification is key. Diversification is key. Although there are some sectors that rebound quickly, like I just mentioned, the tech market rallies hard, and it did so in 2023. It also drops just as hard. So while some sectors may be rebounding, there are other sectors that are lagging, and vice versa. So having a balanced portfolio helps you to manage risk. And anybody that has been in any of my coaching programs, whether I coached you in your road to 100K, whether I'm coaching you in Invest with Ease in the Sister Circle, or whether we've done one-on-one private coaching, the one thing I always emphasize is manage risk. Is manage risk. Because while you may think the number one rule in investing is to make money, the number one rule in investing is not to lose money. You can make $1 million If you're not managing risk, you will lose $1 million just as fast as you made it. The number one rule of investing is not to lose money. So I know a lot of my clients, they think I give them a hard time when I'm challenging them because they want to be tech heavy, or when I'm challenging them because they want to have a lot of shares in this before they've established their foundation. I'm not going to get into my whole methodology of investing in the way I suggest, because I can't tell you what to do, but the way I suggest you structure your portfolio in order to manage risk. But I get on my clients and they don't understand it when the market is booming. But when the market crash, they appreciate the guidance I gave them because they have no concerns right now. They have no concerns at all because they've structured their portfolio in a way that manages risk. My last lesson learned from the 2022 bear market was staying invested. Staying invested, and even if you are a passive investor and you only invest in ETFs and mutual funds, staying invested via dollar cost averaging, it works. It works. Those who kept buying at low prices, the 2022 bear market, the stock market dropped 25%. So those who kept buying at low prices, they saw the biggest gains when the market recovered. They saw the biggest gains when the market recovered. So I'm going to summarize my key takeaways from all of this so you can now know what smart investors know and understand why we are not worried even as the stock market drops. Summarize the 3 market crashes in the past 20 years that I have personally experienced. The 2008 crash was the longest to recover. It took about 4.5 years to recover. The 2020 COVID crash was the fastest to recover. It recovered in only 5 months. And the 2022 bear market took over a year to recover. I think that was about 14. It was about 14 months. Yes. Key takeaways. Crashes are just temporary. The stock market has always bounced back. Number 2, the Federal Reserve plays a very, very major role in recovery. They can cut rates and they can stimulate the economy. Both of those help to fuel recoveries. Takeaway number 3, if you didn't hear anything I said, I've been on talking for almost an hour. If you didn't hear anything I said, I want you to remember this. Panic selling locks in losses, and it makes it harder to re-enter the market. Panic selling locks in losses, and it makes it harder to re-enter the market because once you've made that loss permanent, you're going to be angry, you're going to be emotional, you're going to be so upset with yourself, you're going to have so many regrets, you're going to be thinking about how long it took you to make all of that money you just lost. So when the market starts rebounding, you're going to be holding on to your money so tight, you're not going to want to re-enter. You will be too afraid to re-enter. I cannot tell you how many clients I have had in, I would say, the past 2 or 3 years that's still sitting on cash because they locked in their losses from the 2008 financial crisis. So 2 years ago, it would have been 2022, 2023. They're still sitting on cash that they've been holding since the 2008 crash because they're still afraid. They're still afraid. Or when they came to me, they were still afraid, I should say. So before I can help coach you to rebuild your portfolio, when you come to me afraid, I have to help you overcome those fears first. right? Before we can get into the dollars and cents, we have to talk about the emotions first. So, panic selling locks in losses and it makes it harder to re-enter. The last two things I want you to take away. Long-term investors who stay the course always recover. And the last and final takeaway, which is the most important, buying during crashes leads to huge gains in the recovery. And this, my friends, is what they mean when they talk about a wealth transfer. This is how the wealth transfer happens. The stock market is at 100. It drops to 50. You panic sell. So you lock in a loss of 50. You are now 50% poorer than you were when it was at 100. And here I am. My portfolio is 1,000. I buy your 50 that you sold for half off to add to my 1,000. You just transferred your wealth to me, and you did it willingly. You did it by choice because you let your emotions get the best of you. You gave me the opportunity to take wealth from you. Do you understand what I'm saying, friends? Buying during crashes leads to huge gains in recovery. And this is how the wealth transfer happens. So I beg of you, do not give up your leverage. I don't care what the news is saying. I don't care what they're saying at the barbershop. I don't care what they're saying on TikTok. I don't care. I just shared with you the 3 biggest crashes of the past 20 years that I've personally experienced. And one of those crashes was as much as 57%. And I'm still investing. And I retired at 47 years old because I continued investing through all 3 of them. And I will continue investing through this one too. And the reason why is because I'm not afraid of a market crash because I know if I continue buying, it will lead to huge gains during the recovery as the wealth transfer from the panic sellers and it goes into my portfolio because I'm going to buy it on clearance. And then during the recovery, my wealth is going to increase even more. All right. So if you want to learn how to do what I do, if you want to, I'm kidding. If you want to learn how to navigate the stock market, you can check out my beginner's level investing course, Your Road to 100K, where I teach you step by step how to build a solid portfolio and manage risk to limit losses. I teach what you need to navigate the stock market in my very beginner's level course. I teach so much more in Invest with Ease in the Sister Circle, but that's not open for enrollment right now. I have decided, because I want to help beginners or those who have been investing already but are not very confident in what they're doing. They're not very confident in their investing strategy. That's what the Road to 100K is for. And I have decided that I am going to open this up for enrollment. So for those who enroll by, let's see the notes that I'm going to do the Your Road to 100K a little differently this time. It used to be an investing challenge where I only coach for 3 days. It used to be a challenge where I only coach for 3 days. I'm going to do this a little differently now because of what's happening in the stock market, and I want to be able to provide a little more guidance. So for those who enroll in the Your Road to 100K course by March 21st, by March 21st, so that is 2 weeks from today, for those who enroll by March 21st, you will receive the course, which is a self-pay course, and a month of group coaching. I'm going to do 4 weeks of group coaching in April 2025. So you have to buy the course, take the course, and then you will still get the coaching and the training. But instead of just 3 days of training, you will get 4 weeks of training. So 4 sessions of training, and we'll separate it in a week so you can have time to take the course or to watch the module of the course. And then I will do coaching that corresponds with each module of the course. And instead of just 3 sessions of live training, you'll have the training and you'll get 4 sessions of coaching. And on the last day of coaching, I'm going to do demonstrations. I'll pull up my charts and I'll show you what I see on the charts to validate what I'm telling you. Which reminds me back to Nick Strick's comment about heading towards a crash. We're actually nowhere near a crash, friends. We're actually nowhere near a crash. The market is only down. Let me do a quick. I'll share my screen. And then I have to go. Yeah. All this market doom and gloom. It's all the stock market doom and gloom. The stock market is crashing. The stock market is crashing. Ciao, please. Share my screen. I'm going to show you this and then I have to go. Share screen. All right. Can you all see my chart? Can you all see my chart here? This is the S&P 500, right? And what I'm looking at is the all-time high. The S&P was at 613, and we are currently here at 575.92. So I'm going to take my trend line from 613 and drag it down to market close today around 575. I don't know if you can see that blue bar at the top, that rectangular that's trimmed in blue. The stock market is only down 6.13%. 6.13%. That is nowhere near a stock market crash. For Financial Bestie channel members, I am about to hop on over to the private live stream for a stock market crash Q&A. We can talk about the market. We can talk about your portfolio. If you are not a channel member and would like to become a channel member, you can click the join button below this video. If you are a channel member, but you're not a financial bestie, you can upgrade your membership. Clicking that same join button below this video and join us over in the private live stream, Financial Besties. I will see you in about, give me 5 minutes. Give me about 5 minutes. And for everyone else, stay invested. Now that I have given you all the gems, look, Ms. Donna, yes. Now that I have given you all the gems, stay invested. You are just as smart as any other smart investor. You have the same information that we have, right? Do not give up your leverage because you will be willfully participating in the wealth transfer if you do. So please, please, please stay invested. And if you have the money, continue investing via dollar cost averaging. Do not try to time the market to determine when the bottom is going to be, to determine when is the best time to invest. Continue investing via dollar cost averaging and hold on to your key to financial freedom. All right, besties. Until next time. Bye for now.